All right, let's go ahead and get started. We'll let people filter in here. So everybody, look, coming from my mobile office today, don't mind that. We're on the road. Wanted you all to meet Chris Litzler. Chris, first vice president of capital markets at Marcus and Millichap. So thanks for joining on, buddy. Appreciate it, by the way.
Yeah, man. Always good to be with you and the team.
Yeah. So Chris, what I try and do is just kind of gather some questions, some concerns, just what I'm hearing from my investor network and bring experts on to kind of shed some light on what's going on. And there's certainly a lot to talk about these days. And I thought it was a good time to bring you on, being the expert in commercial lending, underwriting, all of that good stuff. For those of you watching, Chris is a big resource for us at Cornell Capital on all of those fronts. So, Chris, what I want to kind of cover today, and we will be fairly brief, but we've had huge rate increases in a very short period of time after essentially no interest rate hikes for 3-4 years, really, right? So the questions I'm getting are, how does that affect commercial real estate in general? How do we look at that as investors to, one, make sure we're doing the proper due diligence? You and I have had those conversations, but I thought it'd be good to just kind of high level cover that for these guys. And, on a positive note, when rates go up, prices go down. So how do we look for opportunities, and just kind of get your thoughts on where real estate market's going in general and what we might see over the next 6 to 12 months as we look to bring, really stable, properly vetted offerings to my network. So that makes sense. Let's just start. Definitely. If you don't mind, I'd love to hear your opinion on how fast rates have changed, what's that's done in your world. What are you seeing from your side of the desk?
Yep, totally. And Dana, obviously, thanks again for having me on. I'll give everybody a little background on what we do and kind of how that shapes to answer your question. So yeah, Chris Litzler with Marcus Millichap Capital Corporation here in Cleveland, Ohio. So we have a boutique mortgage banking shop. We arrange debt, primarily first mortgage debt for all types of commercial real estate. So office buildings, shopping centers, apartment buildings, self-storage, hotel, industrial, all different asset types with all different lenders, right? So banks, credit unions, Wall Street money, government agencies, life insurance companies, pension funds, right? So all different types of capital, all the way up the business cycle. So construction lending, acquisition financing with a component of CapEx, right? Refinances, some mezz, preferred equity. So we have a wide, view on all different things that are going on in the real estate market. And I will say the pace of change in rates impacted each asset class differently. So I'll focus my comments kind of on apartments, storage, and then maybe I'll talk about office too.
Sure. Perfect.
So it's first things first, it's important to think about what moved and where it moved to. So that when we think about rate increases, we think about the Fed funds rate, right? Overnight borrowing rate that the Federal Reserve sets. And as a result, the impact that it has on the short end of the interest rate curve. So overnight borrowing kind of to that 2-year window really gets impacted by when they move that Fed funds rate. And they moved it from 0 to pretty close to 5% today. This massive move, right? So when that comes to impact things is when loans are priced on that index, right? So floating rate loans generally are priced over SOFR, which is roughly the Fed funds rate. So how does that impact borrowers, right? So in theory, if you entered into a floating rate loan 2 years ago at SOFR plus 400, that was a 4% rate, right? If you have that same rate, if you have that same loan in place today, without a cap, without an interest rate cap, without a hedge, you'd be paying 9% on that same loan, right? So if you bought A-class storage facility with, with some in-place cash flow at a, 5 cap rate with 4% debt, you had positive leverage, right? Well, which means your cash on cash is better than your cap rate, right? Because you got positive leverage. Well, fast forward, even if you could take that 5 cap to a 6.5 or a 7, because rent increases, occupancy lease up, what have you, well, you're still trying to service 9% debt. So that's really where we're seeing the impact, is on guys that have floating rate loans. On the contrary, if 2 years ago you bought that storage facility with a 5-year fixed rate loan at 4.25, well, these rate increases have had no impact on your loan because your loan was fixed, or you did a swap and you're way in the money. So you'd have no impact. So the impact of rate change was a function of what type of loan you had at the time. However, the increased cost of capital, as you alluded to up front, Dana, means that values have to come down, right? So we're seeing, anywhere from 10 to 25% value reductions from the peak because of the cost of money. But when it moves that quickly, it doesn't show up right away because the sellers don't have to sell, so they're not selling. And the buyers can't just go and pay 2021 prices because now they have an increased cost of money. So where we see it showing up is what we call this bid-ask spread. There's just a wide delta between what guys are willing to pay and what sellers are expecting, which has created effectively a freeze in the capital markets.
Makes sense.
Transaction volume is just 50% down, plus or minus depending on your market. So to summarize, floating rate loans affected the most, but overall increase in debt costs is putting pressure on prices.
So Chris, we talk a lot about, specifically with the developers that I partner with, of, one thing I'm always looking at is modeling off average interest rates. Clearly we were in a manipulated rate environment for a long time. Everybody knew, when that was going to change or how fast that it did, but that wasn't going to, rates weren't going to stay artificially low forever. I seem to get the feeling or have the opinion that maybe not every project models their rates and in turn their pro forma that way. Do you think a lot of people are going to get squeezed out, which in turn would create an opportunity? As you say, it's going to take a while to catch up, right? But 18
Definitely.
months down the road, whenever that time comes, and that's where we're kind of positioning on my side, just being patient. We're risk managers first. So looking for good values that are properly modeled for what, we likely could still have rate hikes, throughout this year and next. I don't even know if the Fed knows where they're going with any of these rate hikes, right? So any thoughts on that as far as how to properly, from a due diligence standpoint? I guess we can kind of switch to that point.
Sure.
If you're looking at a project for yourself or one of your clients, what's the right way? And for those watching, a lot of clients do deals with us, but they're looking at other projects direct to a developer and don't have the intermediary that we provide in the extra due diligence. So any thoughts you have on, how to properly do your due diligence and what you should look for when you're looking at a project like that?
Definitely. Yeah, definitely. So the first thing to think about is when you return your principal to the investors, right? Typical model is we build this thing, lease it up for a couple of years, and then we refinance it, right?
Sure.
And we used to say, we're going to refinance it. We're going to get 70 to 75% of the new value. We're going to be able to recoup as debt, which is going to hopefully retire the existing first mortgage and return, most of or all of and more principal of the investor's equity, right?
Mm-hmm.
And we didn't worry about, does that loan amount, is that impacted by interest rates? We just said it's, we can do 75%. Well, that worked when your cap rate was in the, high 5 range and the debt cost 3%. Because at 75%, you're at 75% leverage, your cash flow service the debt at a sufficient, at a sufficient basis, right? Usually we're looking at a 120 or a 125 cover, right? Well, in today's world, that 75 isn't achievable, right? Because that 3.5 is now 6%, right? So you need to be thinking about when your general partner, when your key principal is modeling this exit, how are they getting to the return of equity, and what interest rate are they using, right? Because if you say, we think that interest rates are going to go back down to 4 and we're going to be able to get 75% leverage, well, I'm not saying that that's right or wrong, but that's a hell of an assumption to be making today. And my guess is they're probably showing it that way because it doesn't work if interest rates were to stay at 6, right?
Exactly. I'm with you.
So let's talk about where that opportunity comes in on on that side. So what we're seeing a lot of today is guys that came in and they bought apartment buildings at 4.5% cap rates. They took on this floating rate debt. They did acquire an interest rate. They put on an interest rate cap, so they did hedge a little bit, but they're still bleeding cash. So when they come up on this bridge loan maturity, they need to refinance. Well, that debt can't be repaid because you can't, at today's interest rates, you can't get enough proceeds. It would be a cash in refinance.
Yeah.
So these guys need to sell. So it's just a matter of time before we see these deals start to have to trade.
Any thoughts on, certainly won't hold you to it, right? And it's a guess, but how long in theory does that take? I know I've talked to others, some say 18 months, for just things that catch up and equalize, but are you already starting to see some of that? I'm sure people got caught in the middle, right?
Yep.
Because people thought it was going to last forever.
Yep.
And got
pinched. It's a function of maturities. You're seeing in the news lenders handing back the keys, or borrowers handing back the keys on big office buildings in San Francisco or New York. It's really showing up in the office market. That's a function of interest rates, but it's also a function of cap rates that went from 6.5 on a Class A office building to 8.5 or 9 or 10, because there's just so much risk, right? With this work from home, people downsizing, is there going to be a need for all this office space? So once these loans mature, there's no equity left in these deals. Equity's wiped out. So they just hand back the keys. Now, most of the apartment buildings or storage or anything that got purchased more than 3 years ago is fine, because there has been so much appreciation since then that even a little bit of a decline in value lately, those deals are fine. So you won't see distress until you start to see maturities on deals that were bought in 2020, 2021, 2022, the first half of. And those loans typically are at least 2 years, probably 3 years. And most of the time they have extensions. So most of the lenders, even though they may be underwater, they're just saying, we're going to extend and pretend, pay me my point to extend, and we'll just hope it gets better. So you're going to start to see some of these maturities, deals that got done in, right after COVID, next, summer after, when it started to get hot, you're going to start to see the first batch of those maturities rolling by the end of the year.
So Chris, just kind of to summarize those points, what I'm hearing from you, if I'm an investor, and as being a fiduciary for my investors, there's certainly going to be opportunities, right? There's always value somewhere, right? So there's not to say there's not deals right now that make sense to go in as an equity limited partner by any means. However, and we could talk a long time about in comparison to publicly traded equities or fixed income, that type of thing, which is going to have multiple issues of their own given the interest rate changes. But fair to say now is probably a time, shorter duration investment period, flight to safety. You and I had that conversation. First, second lien position, more on the debt side of things to generate a reasonable return versus hoping that a refinance is hit or a sale comes as an equity investor. Does that make sense?
Yeah, look, secure, capital preservation in these types of environments is more important than growth, right? So we are definitely seeing a flight to security. First mortgages, mezz with a pledge of equity, because in today's world, you can get equity level returns secured by debt. You used to see these apartment deals get blasted out that had 16 to 20% IRRs. Well, you might be able to get, not too far off from that secured by debt. So we're definitely seeing a lot of interest in that.
It's interesting to me, right? So the whole fear greed factor from an investor standpoint, and I hear it and see it from, the multiple conversations I have every day. People have gotten used to a growth period, which we've been in. There's a lot to be said for safety and security of principal, knowing how your money is going to come back to you. And another advantage of rates being up, right? So people are used to making nothing on their money in the bank and nothing as far as mortgage rates and so on and so forth. To your point, that does put a first, second lien, pref equity, mezz position at, honestly, probably higher than, or at least comparable to publicly traded equity returns, which much less fluctuation, backed by a secured asset.
Multiple sources of, multiple sources of repayment. Exactly. You're getting a guarantee from the sponsorship. If you have somebody on top of you, they're probably guaranteeing your repayment. And then you have the security of the collateral, right?
Right.
That you're in first position on. It's a little bit easier to underwrite that way as opposed to, this waterfall, what my IRR is. So yeah, definitely. Now,
Agreed.
If you can get a first mortgage on something in a pretty good market, right? And you could put your money in a, money market at, 4.5. Well, first mortgage is not that much. I mean, it's less secure, it's less safe, but how much less safe really is it? I mean, it's not a 600 spread difference, right? Few hundred bips. So, risk adjusted, guys are liking that, especially if you can do a little bit, especially if you can do a little shorter deal.
Absolutely. Yeah. I mean, that's something I'm always analyzing is what's the risk adjusted return on this compared to the risk-free rate, which essentially is money market, right? So, excuse me. Yeah. If we can take debt secured by the asset, knowing that worst case, we take that property back and we can get money out of it, I think we're going to be in okay shape and ride this next wave of this cycle, because smart investors know things ebb and flow and we need to adapt with the time. So I think that's great, man. I told you I wouldn't keep you for long. That's been very informative. Leave it one last question. Any other than that, and maybe that's the answer, right? As far as opportunity, where's the opportunity you see now? Is it, more safety, shorter deals, that type of thing? Is that where you'd be putting your own money right now?
Yeah, look, I don't mind going long so long as you got debt that matches the business plan, right? If you can get some positive leverage, good quality assets, fixed rate loans with, no covenants on them, no recourse, like that's, probably a safe place to be. It's few and far between where those deals are out there though right now. So if you can't find that, I wouldn't be taking much risk because you're taking duration risk and interest rate risk if you're going long without the fixed rate. So I would keep it short. You know, in good operating guys that you trust. Yeah, that's kind of where we're going with our money.
I think investors are always paid to be patient in times of uncertainty, and I think that'll lead, like you've said, sooner than later to times of outsized opportunity as well. So I think that's good enough, man. Let's cut it there. That was informative.
Cool.
Thanks for the time as always, my man.
Anytime you can feel free to, throw my information up there. If any questions come up, happy to help.
Will do. And for those of you
All right,
watching and then watch the replay, feel free to email me questions directly. So for Chris, we'll ping him, bother him some more, get back to you. But hope this was informative and enjoyable, and we'll see you guys next week.
all right.
Chris,
Thanks, Dana.
buddy.
See ya.
Okay. Bye-bye.